All right, everyone, welcome to video one for Market Watch for the new trading week ahead. So, been an interesting morning today, okay? We're going to first start off with the currency markets, then we're going to move on to the stock markets, crypto markets, and we're going to have a look at the gold markets after. So, US dollar JPY is starting in the currency markets. This is a trade I'm currently in with the VIP members, and we're in a profit. And USD JPY continues to move down from its peak that it reached back in July. Okay, now if you look at the hedge fund report that came out today, you'll see on this Bloomberg report that came out earlier today, the yen is outperforming all the G10 currencies, so it's just the strongest currencies in the world on Monday, because of central bank events later this week. Okay, now the reason the yen's been getting stronger against the US dollar is because hedge funds, as you can clearly see here, are now bullish on the Japanese yen because the carry trade has now blown up. All right, I recently did a whole video on this, but what you need to understand, hedge funds have turned bullish on the Japanese currency for the first time since 2021 because of a blow up of the popular trade, which is called the carry trade. So if you can understand exactly how this works, it's very, very simple. The Japanese yen from 2021, okay, when inflation really started to grip after COVID, you can see here, the Bank of Japan has kept interest rates very low since 2020, but the US central bank has been raising interest rates because the US had very high inflation, just like in the UK and just like other regions of the world, okay? And the central bank in America started to raise interest rates. Now look on the left-hand side. This is the interest rate on a 10-year government bond, okay? Here is USD JPY. Notice the relationship between the two. As the interest rate on government bonds was going up because the central bank was raising interest rates, look at USD JPY on the right-hand side. The dollar-yen pair was going up in value, so the yen was getting very weak against the dollar, and the US dollar appreciated as soon as the Fed started raising interest rates by around 30% against the yen, sorry. Then as soon as the interest rate started to go lower on government bonds, look at dollar yen. Straight away, dollar yen then started to decline in the currency market. So we saw a big pullback here. Soon as the interest rate started to rise again here, and rates and interest rates and government bonds went from 3.29%, you can see the level just here, and then went up to around 5%. That's when dollar yen jumped up at exactly the same time. And then we saw dollar yen come down when interest rates came down, and dollar yen went back up when interest rates went back up. But now the markets currently are pricing in interest rate cuts by the Federal Reserve and interest rate increases by the Bank of Japan. So why is this causing the yen to weaken? The dollar to weaken and the yen to get stronger? Well, all you need to understand is in this headline, when they're saying the blow up of the carry trade is basically when investors are selling the yen where interest rates are very low and buying the US dollar. Okay, so when the Fed first started raising interest rates back in 2022, interest rates at that time in Japan were at zero. Interest rates in America were at 0.25%. So quite a wide difference, yeah? Sorry, quite a close difference. But this is why the dollar yen pair took off when the Fed started raising rates. Because as the central bank in America is raising interest rates, if you sell the yen to buy the dollar, you pay no interest on the yen that you sell, and then you sell it in exchange to buy the dollar, and you get paid 0.5% interest on the dollars that you purchase. So what does that mean? That means if you're a hedge fund, which were bullish on the dollar before, trading 1,000 lots, you could be earning $17,000 every single day you hold that trade open. Because the overnight carry trade is a strategy where you borrow money in one country, which is Japan, and you sell that currency to buy another currency like the US dollar in America, where interest rates are higher, and you earn free money into your trading account every day you hold that trade open. And that's why as rates in America went higher, so look, you're making 17 grand a day to take that trade, but as rates in America went to 1%, you go to 30 grand, 2%, 60K, 3%, 90K, for an example, 4%, 100 grand, 5%, that rate will go up to 150K, and rates in America right now are 5.5%. So the reason the dollar yen was getting so strong as interest rates in America were going up is because it just made more investors get paid into their trading account for free interest on the trade. And on top of that, if the exchange rate then went up by around 40% in the dollar's favor, as you can clearly see over here, 40%, then you would basically have made a 40% return on your money as well as the free interest. So all the hedge funds have been trading this strategy. It's called the overnight carry trade. It's literally what drives the currency markets. But now that the markets are expecting over here, we can clearly see the Federal Reserve to cut interest rates aggressively because the US is tipping closer to a recession, whilst the markets are predicting interest rate increases in Japan. The interest rate differential is now going to narrow. And when interest rate differences narrow, that's when the carry trade blows up, because investors who was getting all this free money every day, 150 grand a day they could be making, for an example, and they've locked in this 40% profit, the strategy only works if the currency remains stable or goes in your favor. If the currency then drops against you, for an example, by 8%, well, who cares if you're making 5% interest? You've just lost money on the trade because the currency pair has gone against you by more interest than you're getting credited by the broker over 365 days, right? And then investors don't want to be the guy who's made 40% and now their returns have gone down to 27%, so everyone's cashing in on the trade. So this is the reason why I've been selling USD JPY with the members, and it's all down to understanding when interest rates go lower. So currently markets are predicting rates in America to go to 3% by the end of the year. Okay, so look at this. Look how much money investors would be making and now they're going to lose. So it's going to go from 160K a day down to 90K. But markets are also betting the Bank of Japan takes rates to 0.5%. So you see how much that free interest goes down? That's the unwinding of the carry trade. The carry trade is coming to an end. And that's why we're betting on this trade. So this is the reason why I sold this trade to my members. And Shane this morning sent me a screenshot saying he made £1,000, 600 today, August the 19th. You can see the date here, following the trade that I sent to the members. So we're in this current position. Beautiful. We understand the fundamentals driving the currency pair. And the quicker the Fed cuts rates and the more the Bank of Japan raises rates, the carry trade comes to an end and it just causes a big sell-off in USD JPY. So that is interest rates literally driving exchange rates. So that explains why the yen's getting stronger today, because this week we have the Bank of Japan governor talking on Friday to hear if he's going to signal more rate hikes are coming, which he did tell the markets when he raised interest rates in Japan recently. And does the Federal Reserve signal this week at Jackson Hole Central Bank Conference that he's going to cut rates? If you get that perfect divergence, when the interest rate difference is narrowing, dollar yen goes lower. Okay. Now, also, we're in a winning trade for my members for the Aussie dollar against the US dollar, which is a trade we took today. Now, fundamentally, the reason we got into this trade and the trade's in a profit as we speak is because the Reserve Bank of Australia is telling the markets it's too premature to think about rate cuts in Australia. Australia's central bank remains some way off from monetary easing, which just means cutting interest rates, said the governor, as inflation is proving persistent and will only return back to their target of 2% in the next year. So look, here you go, the carry trade again. This is a strategy where you can learn how to take trades based on interest rate differences. So if America's interest rate is going down, so let's take Aussie dollar, US dollar, markets are betting on 3 rate cuts by the Fed by December. So rates are going to go from 5.5 to 4.5 right now, right? Rates in Australia currently are 4.35%. So look at this. Currently, you do make money on the dollar against the Aussie dollar. If you sell the Aussie dollar by the US dollar, you make a profit because you pay 4.5%, well, 4.25% on the Aussie dollars you sell and exchange to buy US dollars. Okay, but you get paid 5.5% on the dollars that you buy. So you're making a profit of 1.25%. For the overnight carry trade, again, if you're a hedge fund, that's 30 grand a day. That's good money for any investor. That's why Aussie dollar, US dollar has been trending lower for a while. The Aussie dollar has weakened considerably since the Fed started raising interest rates. It's been in a downtrend. However, what happens to the carry trade, just like the yen example? Well, if the Fed is going to cut rates down to 4.5% by the end of the year, and rates in Australia remain at 4.25%, well, now the interest rate difference has narrowed massively. So again, unwinding of the carry trade, causing the exchange rate to jump up. This is why we took the trade today, okay? Fundamentally makes sense. So that's 2 currency trades I'm looking at currently. Okay, so that explains what we're seeing for the yen and for the Aussie dollar. Moving on to the stock markets, which are some winning trades I'm in right now with the members as well, which is beautiful. We jumped into a trade here and we're in a nice profit already. Price is up here. Now listen to what the markets are saying for the stock markets. The markets are looking at, whoopsie, I think I took the wrong thing off. Yes, this is what we need. Apologies, give me 1 second. I need to drag this article over. Give us a sec, guys. So let's see if we can take this one over here. Yes. So listen to the headline from Wall Street on Bloomberg. Wall Street is betting the Federal Reserve Chairman will confirm interest rate cuts are coming at the central bank's annual conference this week. But as the debate shifts from will they or won't they and how big will they go in terms of interest rate cuts, stock market traders will be left waiting. Okay, so for the stock markets to keep moving higher, you need interest rate cuts to happen because historically interest rate cuts drive markets. So I'm going to introduce you to the bond market and the stock market so you can understand the correlation. Okay, so look, I will literally show it to you in a single minute. The 10-year government bond interest rate is very important to stocks because all interest rates in an economy, mortgages, credit cards, car loans, student debt are pegged above the 10-year rate. So look, this is why when the Fed was raising rates in March 2022 and the interest rate went from on the 10-year government bond went from 1.73 to 4.2%, look what happened to the stock market at that same time. Stocks dropped. The reason stocks dropped because as the 10-year rate goes up, everyone's monthly interest payments go up. So people have less disposable income. Who doesn't benefit from less spending? Companies. So the earnings of these companies go down. So the value of these companies go down. That's why when interest rates were going up, stock markets were going down. And as soon as the interest rate and government bonds go down, when the markets are betting on rate cuts, as they were predicting last year at this point here, but it didn't happen, when the interest rate go down on government bonds, well, then guess what happens? Everyone's mortgages, credit cards, car loans go down so people can spend more. That's why stocks jump up, as you can clearly see here. And then you see, soon as the bond market starts to take off from here again, at this period of time, look what happens. Stocks then decline after rallying here. So you see the relationship between interest rates going up and stocks going down. And then this is why since October of last year, interest rates hit a peak and have been declining. That's why the stock markets have rallied the whole entire time. And that's why this article is telling you that the markets need to see the Federal Reserve signal that rate cuts are coming for the markets to keep moving. Understand the relationship? So stocks always hold their value. Stocks always rise when the central banks cut interest rates because the increase in liquidity means more people have disposable income, which means the earnings of companies go higher because they're making more money because people have more money to spend. And the value of these companies become more attractive to investors, so they buy stocks. Okay, so all you need to know is the Fed going to confirm to the markets their expectations that these rate cuts are coming? If they do confirm these rate cuts are coming, the markets keep moving. Okay, so that's why we're buying stock markets right now. And that's why we're in these trades. And this is also why Bitcoin is struggling to harbor further gains because markets are waiting for the rate cuts to come by the Fed. Stocks, in contrast, shrug off reductions sparked by growth fears. Okay, so what you're saying is Bitcoin in the wider crypto market are nursing sharp losses for the month. So far, even as global stocks push higher towards record highs, shaking off scares about the US economy. So if you can understand the correlation between Bitcoin and stocks, then you get an idea as to what the market is looking for. Now remember, Bitcoin is still way up more than stocks this year. So as they talk about these headlines about crypto struggling, you got to look at the bigger picture. Crypto this year in 2024 has gone up in value. So let's go to the 1st of January. Crypto is up 44%. Stock markets are not even up 20%. So stock markets are still performing very, very well with the global stock markets. Okay, let's have a look over here. Where is stock markets up so far? 19%. So look, crypto's outperforming stocks. But what most people don't understand is the relationship between crypto and stocks. So let me show you again. So when I just showed you, for an example, in 2022, when the stock markets were falling, well, many people don't realize that this was exactly the same time that the crypto markets are falling. So look, crypto on the right-hand side goes down as stocks on the left-hand side go down. And then notice, you see crypto then jump up at the same time with stocks. So look, stocks jump up here by 30%. Crypto at exactly the same time jumps up 100%. And then when stocks go down here 10%, crypto goes down 23%. And as I showed you, stock markets have been rallying for the rest of the year because of lower interest rate expectations here. So has crypto. So ignore the headlines and just look at the bigger picture. Crypto and stocks move at the same time. Stock market's going up, so crypto will go up. They just need the Fed to cut rates because investors now can invest into cryptocurrencies alongside stocks because the U.S. Securities Commission Exchange, the SEC, they've now approved Bitcoin to be sold to institutional investors. Pension funds can now offer ETFs that track the price of Bitcoin, where before they didn't want to invest in Bitcoin because they was worried about putting the money in like Binance or like Coinbase, but they're happy to buy ETFs that are sold by BlackRock, who have like $10 trillion under management. So for the Bitcoin moon to continue, it's the same thing with stocks. Soon as stocks rise on the rate cut bets and they start to power ahead, crypto should follow suit because they move together, as I've just shown you. Okay, so that's what we're looking at this week is, does the Fed signal that these rate cuts are coming? Okay, and in terms of the key economic data for this week, the only things we need to really pay attention to is we do have tomorrow European inflation, which will be very important for the market's expectations for the ECB to cut interest rates, and that can cause euro yen to continue to move lower because of the same overnight carry trade example I was showing you with the dollar. It's the same reason why the yen is getting stronger against the euro also. So that's important. I'll probably be trading that with the members tomorrow. We got Canadian inflation, which is important. The Bank of Canada just cut interest rates. So that's a key report. Moving on to the further on in the week, the key data we want to pay attention to is going to be Fed Chair Jerome Powell speaking. Very important because he's going to obviously signal what the Fed's going to likely do with rates. But it's next week's data with inflation and then the following jobs report data, which is literally going to be the key. Okay. Listen to what Goldman Sachs says. Goldman Sachs economists lowered the probability of a year of recession by 20% from 25% after last week's positive data gave the markets the confidence that the US economy wasn't going to be in a recession. And that's why the markets bounced back from this sell-off we had previously. Okay. Now, what's important about this, listen to what Goldman Sachs says. If the August report, jobs report in America is good, then they'll cut their probability of a recession to 15%. Okay. But what they're basically saying is the Federal Reserve to cut interest rates by 25 basis points or even more by maybe 50 basis points is going to be based on what happens with the jobs report. Is there going to be another surprise in the unemployment rate? Because if you guys can understand why stock markets tumbled here the other day, right, which caused the yen to get very strong when markets were betting on rate cuts because of the jobs data. You saw Bitcoin sell off 20% on that day because of the jobs data. Here, look, on the same time Bitcoin crashed, the markets got spooked by the unemployment rate. When the unemployment rate in America jumped from 4.1 to 4.3, it's a lot of people losing their jobs, and it means the US tips closer to a recession. So basically, the jobs report is very important in the next couple of weeks because if you get a higher unemployment rate, you can get the markets getting spooked and there may be a sell-off, but ultimately, what does lower interest rates do? Boost the markets. So you can buy on the pullbacks, basically, guys. So that's episode 1 for Market Watch. Very short, very brief. Just want to touch on the markets, what we're looking at for the week ahead. Let's see what happens. Hopefully we can get some good trades on and we can make some good money.